The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our Investors Observer periodic, once every 3-week members-only workshop. We have our agenda today. We're going to run through a few charts, talk about what else is happening in the market, look at what sectors and industries are hot right now, and the rest is member-driven content, and that is up to you. We got questions, demonstrations of what's on the website, etc. I got a couple of good questions ahead of time, so we'll go through those. You can always submit questions ahead of time. Just say, hey, talk about this in the workshop, and I will get to it. Yeah, you can also submit questions at any time today. Just put them in the box there, and I'll get to it either as I'm talking or at the end. Yeah. So before we get into the charts, I do want to say, finally, we have gotten to the point where we don't have a date yet, but we're very close to having an Android app. So be on the lookout for an announcement on that very soon. Those of you who are on Android and have been waiting for that, it does all the same things the iOS app does. So all the stock stuff, no crypto or options yet, but all the stock stuff will be in there. And stuff like you can get push notifications for news on stocks in your watch list and things like that. Some nice app things that are harder to do on the website. All right, so with that said, now let us move on to the charts. Last time we talked, the S&P 500 was, not looking quite this bad. This is all relatively new. I think we were back here somewhere about 3 weeks ago. So, things have obviously gotten worse since then. We seem to be finding some resistance a little above this line here. It's really somewhat ironically, given how much Elon Musk has been in the news lately, right around the 4,200 level, which would be 420 on the SPY, if you're looking at it that way. But yeah, there seems to be some support in that area. Is kind of where we bounced off of. It was about the low yesterday and kind of where we bounced off of today. The NASDAQ, things are uglier. This doesn't include the close. So I'm not sure exactly where we ended up today, but yeah, sort of new lows, maybe going all the way back to, this time last year. And that's just tech stocks being weaker. Google's earnings didn't help a lot, but Microsoft's did. So yeah, that's kind of where we're at the tech stocks. The Russell is also looking pretty ugly. Small companies are less safe haveny than some of the big things that you can find in the S&P 500. And then the S&P 500 versus the equal weight. The equal weight is outperforming here in this recent decline, which is a sign that essentially the stocks that are not the big 5 tech stocks there, your Google, Tesla, Apple, Microsoft, those stocks are not doing as well as sort of the average stock from the other 499. And so the equal weight does better than the cap weighted version in those instances. And that's where we are right now. Growth versus value is pretty interesting. Value set a new high since the last time we talked. Whereas the growth stocks, you can really see a lot of the selling in the last couple of weeks has been in growth stocks, whereas value has held up relatively better until the last couple of days. All right, what else is going on? This is really kind of tells us, is another way of telling the story that we've been looking at here recently, or that we just looked at in terms of the charts. This interest rates, inflation, Federal Reserve thing is really sort of in the driver's seat in the market right now. The Fed is getting a little bit more aggressive in terms of basically just talking. They meet next month, and that's when something will actually happen. It seems more than likely that 50 basis points will happen in May. That's half a percentage point. Interest rates are still incredibly low, but I think moving by sort of 2 units is, typically they've moved, or more recently they've moved in quarter point increments. So 2 units, I guess, shows they're serious. There are, however, a lot of outside effects still potentially keeping inflation elevated, right? Some of those are on this list if you look further down. Russia, Ukraine, China, COVID, shipping things, all of those are sort of keeping prices high, and the Fed can't really do much about them. What tighter monetary policy really means is higher financing costs. So obviously on the debt side, if you're borrowing money, you pay a higher interest rate. It makes your, what people call the hurdle rate, higher. So if you think about an investment, that investment has costs and you hope to get a return on that investment that is in excess of the costs. If your borrowing costs go up, that makes the cost of the investment higher. And so some sort of marginal investments don't get made, right? That's how higher interest rates slow down the economy, is it raises that hurdle rate. Some investments don't happen. It's just less demand for stuff. On the equity side, what that means is essentially lower multiples, right? So if you have a company and you're raising money, you're going to raise money at the highest stock price possible because it's less dilution for your existing shareholders. So it kind of makes sense that tighter monetary policy means, or tighter money just means higher financing across the board, and that means lower multiples on stocks, particularly the sort of growthy, in a lot of cases, unprofitable tech stocks that were pretty hot over the last, well, I guess they haven't been hot for a while now, but pretty hot coming out of the pandemic anyway. Other things moving stocks around earnings season, it's been kind of interesting so far. CocaCola, Microsoft, some airlines have been big winners. Netflix and Google were losers. Google didn't get beat up too badly today. Netflix, the results were pretty terrible there. Google, I think, is an interesting case because Google's mostly an ad-supported business. In particular, the weakness was in ad-supported businesses. Your YouTube and some of those things, whereas their cloud services, the things services they sell to businesses, held up relatively well, which is also where Microsoft did well. But there's a lot of big companies that rely on advertising. Obviously, all the media companies, but also all the social media companies. So like Facebook, Twitter, those are also big advertising players. So Google may be a little bit of a leading indicator there. Netflix, it's really about subscriber additions, and I don't know, people have different opinions about whether or not Netflix has good shows, but they certainly have they certainly signed up a lot of people early in the pandemic, and I think that a lot of that was just sort of pulled forward. Right, people who were going to sign up for Netflix signed up early in the pandemic, and now some of those people are starting to roll off, and there aren't new people coming in to replace them, so the things look pretty weak there. Russia and Ukraine has sort of faded into the background as far as the market is concerned. It's obviously a potential source of volatility at any moment, especially in things that are related to commodities, but yeah, there's not a lot going on there. The same is true with China, right? Their economy is still kind of struggling. Their zero COVID policy is not working. A slowdown in China's economy could be good for some of those inflationary factors in terms of just taking fundamentals off taking demand for commodities down a little bit. China recently said they were going to support their economy, which put a little bit of a boost under commodities, which have been down a little bit the last couple of days, but it's unclear exactly how they plan to do that. All right, so yeah, all right. So we have a question from Jerry here. I'll go ahead and get to, and he says, "What do you think of the market fundamentals like GDP and unemployment?" Unemployment is very low. The job market is hot. This is why inflation is high, right? It's pretty easy to find a job. People are changing jobs. Employers are having to pay more to hire people. That's one of the things that happens when we have inflation. So that's relatively good. I think GDP is going to come in a little bit less hot than people had expected a couple weeks ago. I don't know exactly where the estimates are now. But I do think there have been a couple of things that have maybe slowed some things down. You look at like durable goods orders wasn't as good as maybe expected. I think last week, some of those things, but generally the economy is pretty healthy. Right? Like what we really have with stocks is a lot of things that were just priced very high in terms of valuation are sort of getting readjusted because of tighter monetary policy. All right, so the things that are hot right now, energy remains at the top. Right, coal has been hot, especially with a lot of Russian natural gas offline. Coal can kind of fill in some of the gaps there in terms of electricity generation and some things like that. Utilities is a similar story. Utilities also, I think, is a little bit of a rates play there in terms of they pay a dividend and some things like that. It's a relatively safe place to put money when people get nervous. But yeah, the independent power producers obviously have a little bit more sort of pricing power in terms of things. So when things start to get a little bit weird in energy and electricity markets, independent power producers in particular can do pretty well. And regulated gas and electric, it's a little bit harder for them to raise rates, but they do, they do tend to do pretty well just because those are bills that people keep paying no matter where they might cut back in some other places. To call back to the last slide, people will absolutely cancel Netflix before they'll cancel the, electricity. Basic materials continues to rise. It was not on the chart or not on the list the time before last. It was in the fifth spot last time, and now it's up to third. And that's coking coal, which is used in steel making, steel, agricultural inputs. Again, these are like, hot economy kind of things. Agricultural inputs probably has a lot to do with Ukraine. But coking coal and steel are both steel, right? That's stuff people need, things people need to build stuff. Real estate, the housing market has been pretty hot, which also can trickle over into the rental market. And then industrial is a lot of shipping and warehousing, and specialty is a lot of things that don't fall into one of the other categories. What you don't see on the list here is commercial or office space. Those have been on the list not too long ago, but they're just not the hottest places to be right now. And then, financial services, financial data and stock exchanges. These things do good in terms of volatility and things like that. And then the insurance, diversified and property casualty. I think those are a combination of new business formation and things like that, and then also interest rates. If you think an insurance company really makes most of its money from investing premiums between when you write that check to the insurance company and when you file a claim, they just have a big pool of money that they invest, and they have to do it in a relatively safe way. So rising interest rates tends to be good for insurance companies. All right, let's get to the questions. We got a slew of questions from Garth this time around, and I see those of you in the comments that I haven't gotten to yet, and I'll get to those here too. So Garth's first question was about Amazon's stock split. They're going to do a 20-for-1 later this year. Because I know the textbook definition of a stock split says no change in the stock price, but there always is some immediate change. That's about right. It turns out that no matter how many pieces you cut out of the pizza, that it doesn't make the pizza any bigger. That's basically what a stock split is. Right? It's just changing how many shares there are, but the size of the company doesn't really change. It may create some additional buying interest in the sense that some people can't or won't buy stocks above a certain price. Amazon in particular is pretty expensive. People with smaller accounts maybe can afford a share or 2 shares, which people don't tend to like to own 1 share of things necessarily. It also makes a difference in terms of index inclusion, particularly the Dow. There's a lot of ETFs and other money that track the Dow, and so getting included in the Dow is a big deal, and they just won't put a stock that costs $2,000 a share in there. So there's some additional demand potentially if they get added to the Dow, which seems probably pretty likely, I would think. So those are things that might make the stock go up. But the other thing to think about in terms of stock splits is, right, like, what's the stock been doing pre-split? Like super recently it hasn't been doing well because tech stuff hasn't been doing super well. But stocks tend to split when their prices have gotten high, which means that the stock was doing well in most cases before the split. So, you don't see a stock that's going down suddenly split and start going back up, or even something split and break out of a long sort of sideways trend. Amazon, this is a little bit weird just because the stock has been kind of beaten up recently. And a split could provide a short-term bump, but typically, typically a stock split doesn't really change the long-term portions of the stock. And yeah, longer term for Amazon, I think continued execution in the post-Bezos era is what's more important than the stock split. All right, so Garth also wanted to see the out-of-the-money stock calculator. So we can go to, let's look at a moderately priced stock here. Something like Apple. If you go to option trades and then the out-of-the-money calculator, this can help you find a call to sell to generate some additional income. Or to repair an underwater stock position. So let's say you owned Apple with a basis of 175 and you'd like to get a little closer to that. Calculate. And so here we have a July 175 call for a credit of 345. So that'll lower your cost basis from the original 175 to 171.55. And it also has typically in this case, in this tool, it'll be a less than 30% chance of assignment, which is pretty low. And you will make some profit if assigned there also. You can also, if you're not underwater, use the income generation option, and it will pick a similar call. In a lot of cases, the same one, but obviously here we don't have to have a call above 175. So it's a little bit lower here. The probability of assignment is relatively the same, but you can turn this call a lot more often. In that case, and that's go to the stock page and then option trades and then out of the money calculator is how you get to that. And so that works for, yeah, he provided a different example here than Apple, but it's the same no matter what the stock is. Yeah, so the out of the money tool can help you find calls to sell. It does position repair or income generation. Calls will typically have a probability of assignment that's less than 30%. And in position repair mode, calls will not be assignable for a loss. So you notice when I switched to income generation, the strike price was a lot lower. The position repair mode won't give you a call where if the stock were to suddenly shoot up, your option might be assigned and lock you into a loss in that way. All right, so then he had another question about position repair in a vertical credit spread. In this case, it's on AbbVie, which as of earlier today, both sides of those are out of the money, so you should be able to close that given that the options expire Friday for a small profit, or if you think the run is going to keep going, try to let it run and see if the options can expire worthless. Either one of those is fine. But there isn't really a good way to repair something like a vertical spread. The method used by a lot of traders is to roll the position. And that essentially means to buy to close the sold leg and sell to close the bought leg. So you've now completely closed the position. And then you're going to open a new position that is typically further out in time. And most of the time it will have more at risk, which means probably wider strike prices or lower credit. Some other thing where you're basically putting more money into the trade or potentially risking more money to try to turn this around. And the thing about that is if you're going to close a position entirely and then try to open a new position, is a stock that just did something you didn't expect the stock that you want to open that new position on? Particularly putting even more at risk on that stock. I understand the inclination not to take a loss, but if the method for managing the trade here is to close the position and open a different position, then if you're going to close the position and open a different position, it seems to me like you should move on and try to find something where you have the best possible chance of winning, as opposed to limiting yourself to like, well, I just kind of got this stock wrong. I'd really like to make a bet in the same direction and get it right this time. That just doesn't make a ton of sense to me objectively. So yeah, there isn't a lot to do in terms of position repair on those vertical spreads. Sometimes it's just knowing when to walk away and try to get out as best you can when things start to look bad. All right, so that's all the questions we got ahead of time. So yeah, thank you to Garth who sent those in. And you can send questions in by just hitting the help button on the website or responding to the invitation when you get it. All right, so Black asked, are there any benefits of selling a stock and buying it back to do a wash sale? Can you explain what a wash sale is? You combine a stock wash sale with other investments. So a wash sale is essentially selling a stock for a loss and buying that stock back, and essentially you lower your cost basis. The reason to sell it for a loss and then buy it back would be you have a loss that you could recognize for tax purposes. However, there are very specific rules against doing that. And by rules, I mean laws. Like you can do that, but you can't claim it on your taxes. It's illegal. And the law actually says materially similar. So something like selling SPY and buying VOO, which are both ETFs that track the S&P 500, would probably also run you afoul of that law. I'm not entirely certain what the other advantages would be. It seems like you're just playing games at that point, right? Like selling something for a loss and then buying it back at the same price. I guess you could say, well, I lost from this period, but I gained from this period. But you can, draw those sort of arbitrary lines in your trading account if you wanted to anyway. I don't really see the point in doing it. Recently, it was legal to do wash sales and potentially collect the tax benefits in Bitcoin. and some other crypto things because those weren't regulated as a security. Those rules may have changed. I do not know. This is not legal or tax advice at all. But yeah, unless there's some kind of tax benefit, I really have no idea what the point of that would be. All right, so Mary asked, for new investors who really just got started last January, if we have a long-term investing focus, biotech, Fin, I'm not sure if that is, maybe financial technology, EVs, innovation, crypto, sustainable energy. Do we just hold on and try to continue to buy the dip and ride the next 4 to 5 months out? Yeah, I mean, if that's what you're doing, then yeah, you're certainly underwater. And if you really believe in those things, then selling them all now for a loss doesn't make a ton of sense. I would suggest rather than just adding to those positions, maybe try to diversify a little bit, right? Look at some value stocks which are performing relatively well and may continue to perform well. Some things like that, right? Try to think about companies that aren't going away. I don't know that Microsoft necessarily is anybody's idea of a value stock, or Apple, but certainly those are other things that seem unlikely to go away. And then stuff, I mean, I mentioned CocaCola earlier. They had good earnings, right? Like those seem like things that are unlikely to go away. They're relatively valuable, or relatively undervalued or at least close to fair value on a, price to earnings or fundamental analysis basis. And that'll at least give you some sustainability in your portfolio as opposed to things just going down and down and down. And yeah, this list of things here in terms of biotech, electric vehicles, sustainable energy, a lot of those things are unprofitable, right? Like what happens in the biotech space, in particular, and really anything where people are doing innovation, is you burn a lot of capital doing expensive science experiments and hoping some of them pay off. And so that means that for any one company, there's a lot of sort of volatility in results, right? You sink a lot of money into something and it doesn't work. That's not great. It also means a lot of the companies themselves blow up. So you really want to kind of spread the money around there. I think the electric vehicle space is another one. There are a lot of super hot electric vehicle things that came out in 2020 and 2021, and some of them have been revealed to be, there seemed to have been some fraud involved. Some of them have yet to ship a single car. So you really have to think about what is it you're buying there. At a certain point in terms of all those sort of speculative things. Copper, lithium, and uranium stocks. Yeah, so that's kind of an interesting group. Copper in particular, obviously goes into basically everything. Lithium goes into an increasing number of things because of batteries. Uranium is sort of more interesting because the demand there is relatively stable. There's been some weird stuff going on with uranium in terms of people buying a ton of a physical uranium ETF, which created a lot of what seems to me to be artificial demand for uranium, because it's not like you, the individual investor, or really a lot of other people can just sort of stockpile uranium for a rainy day. It's also not like, nuclear power plants are hard to build. They don't ramp up and down easily. The idea that there's going to be a sudden jump in uranium demand seems kind of weird to me. So I'm not super sure what the idea behind that one is. I know Russia exports some uranium, so presumably if you take that offline, the demand has to be filled in from somewhere else. Maybe that's what some of the deal is. Lithium is an interesting one because just like I was talking earlier about sort of the biotech and EV stocks, there are a couple of lithium stocks that either don't currently mine lithium or haven't mined any lithium yet or are just getting started mining lithium. I couldn't tell you exactly which ones are which off the top of my head, but I would be very careful there in terms of, oh, this is a lithium miner, or is it really, or is it just a company that says they plan to mine some lithium and now the stock has gone way up? So that's that's kind of how I would approach those three. Copper is generally the safest one. There are people who refer to copper, the commodity, as Dr. Copper, in the sense of, right, if you think about everything you own that's electronic has some amount of copper in it. So demand for copper tends to go up and down a lot with the economy. All right, Twitter's prospects given Musk die. Well, I mean, the prospects seem to be it gets taken out at $54.20. That bid has been out there for a while, and no one has made another offer. So that seems kind of like the ceiling for now. I guess if it gets taken out, right, if the deal goes through, then that's it, right? There's no more Twitter the stock to even talk about because it'll be private. So that seems like one option. The other option is, I don't know, I guess maybe another bidder comes out. They're supposed to report earnings, I think, Thursday of this week. So potentially they could report a blowout quarter and have a bunch of exciting new business things, and somebody will come along and say, you know what, we will actually top Elon's bid for $54.20. I have no idea what the likelihood of that is. I imagine if somebody was seriously interested in buying Twitter, they would have come out in the last couple of weeks. But yeah, it seems like for now that 54.20 is probably the highest it makes any sense for it to go. Right, like if Musk is going to buy it at 54.20, I wouldn't pay 55 for it because the stock's just going to disappear if the deal goes through at 54.20. So that seems like that. All right. So this Brenda said, should I sell the gold and silver now and buy again when it is very low? Gold's now at 1900 and I sell, the market crashes and goes down to 300. Would I not be better off? I mean, yes, if you can sell at the top of the market and buy at the bottom of the market, you are in most cases better off. The hard part is figuring out when those things happen. Right? Like, nobody successfully times the market like that for in any repeatable way. So really what you should do with anything you have in your portfolio is try to have amounts of your portfolio that you devote to certain things, right? So there's the old, 60-40 stock bond portfolio, that kind of thing, right? So if there's some amount of your portfolio that you think should be in gold, when that percentage that's in gold gets to be too big, then you should sell some and buy some of the things that are now proportionally smaller. That's, basic portfolio rebalancing. And that's a much better way to do things than, right, try to time the market. Certainly, if you have a lot of profits, you could take some. But I don't really do gold and silver. I'm not super yeah, I'm not super well versed on sort of what's happening with gold right now. With insurance premiums on the rise, are there any insurtechs that have caught your eye recently? The idea of insurance technology is as anything other than an insurance company is not one I'm fond of, to be honest. And I would say the same thing for a lot of financial technology companies, right? A lot of things that are a lot of these new like pay-as-you-go lenders or things like that. They're just short-term lenders, right? So they have all the same risks, and you can call it a tech company, but it has the same risks. It should have the same, you know, P&Ls and margins as basically any other company in that industry. So I'm not sold on the insurtechs. I think what you look for in terms of insurance is somebody with a solid underwriting history and good execution. But generally, I'm not right. Like, yeah, picking an insurance company to buy is not something that I particularly feel capable of doing. But a lot of these things that come online, and it's like, oh, we've got fancy technology to do X, Y, Z, and so then you see whatever industry it is has a particular set of valuations, and then the new fancy technology version of that has a much higher valuation, but they may grow fast because they're a new player in the space. But typically that slows down, and ultimately you're just running an insurance company, whether you have a lot of technology or not. And then the other companies catch up in terms of the technology, and I don't riding those on the way up is the way to do it. I don't think they do much over the longer term. All right, so Amando says, how can I protect my portfolio of stocks if the market keeps on a downward turn? Yeah, I mean, you can buy puts, is probably the easiest way to do that. You could try to sell, very far out of the money calls also. You can look for bargains. That's another way to do it, right? Like I was just saying about gold, right? Like not everything is down. Value has set a new high in the last 3 weeks. There's other stocks that set 52-week highs. So, kind of rebalance that portfolio and do things like that. But yeah, there's not really a good way to do that other than going to cash. But the problem with going to cash is now you have the problem of when do I buy back in? So, if you need the money next week and you're worried about stocks going down, then yeah, you probably should sell. But otherwise, typically people who have a long time horizon, just riding it out is not a bad strategy. So where do you think the best articles are putting stock in farming? I'm not sure exactly what this question means, but yeah, I mean, I mentioned agricultural inputs earlier. That mostly means things like fertilizer, your CF Industries, and there's a couple other fertilizer stocks that have already made big runs because people sort of saw this coming. The other side of that coin is things like Tyson is, I think, maybe the only meat processor left. Hormel might still be public. I don't remember off the top of my head. And then, you've got ConAgra and some other food companies, but those tend to be sort of price takers in terms of the commodities instead of price makers. So, yeah, I mean, something like a Tyson or a fertilizer stock are good ways to get in on farming. But they're not the farming space generally is a little bit tricky in terms of being able to invest because it's a lot of small operators and a lot of private operators, and there aren't a ton of ways to just buy a stake in some farmland or something like that. Ideal recession-proof sectors. I mean, stuff like utilities tend to be recession-proof-ish. It turns out that shutting down a lot of industry will take demand for electricity and things like that down, but they tend to do relatively well. They also tend to pay dividends. You look at consumer staples, right? Your Cloroxes and Procter and Gamble's and things like that. The grocery store. None of those are necessarily stock market crash proof, but they tend to hold up better in a recession. But again, like I said earlier, unemployment is very low, less than 4%. And the economy is generally doing pretty well. The problem right now is the inflation piece, which is a too hot economy. So, you're seeing some things that had very high valuations get corrected, but I don't really think we're in a recessionary sort of period. You're seeing a little bit of a stock market correction, but that's different than a recession. What do you know about vanadium? Nothing. It sounds like a rare earth metal, but that's all I really could give you. That stuff gets used in electronics and stuff like that. But that's all I know about it. All right, explain the difference between growth and value stocks and give an example. All right, so yeah, I mean, growth stocks are essentially stocks where the bet is the company and business is growing, right? So Tesla is a growth stock, right? The price of Tesla stock makes 0 cents based on how much money the company makes. I don't know. We can look it up here. So for Tesla, you're paying $118 in stock for every dollar of earnings. Whereas another automaker like Ford, you're paying $3 for every dollar of earnings. General Motors is at $5.7 in stock for every dollar of earnings. Okay, so what that means is Tesla's not priced based on how profitable it is today. Tesla is priced based on the prospects for it to grow in the future. And that's growth stocks, right? So growth stocks a lot of times will be marginally profitable or unprofitable. And there are a lot of times they're in those riskier sectors I was talking about. Biotech, electric vehicles, a lot of technology stuff is, sort of fits into the growth category. Whereas value stocks are, right, things that look more like this. I'm not necessarily recommending GM as a value stock. The auto industry has its own set of problems right now. But think about like Procter and Gamble, CocaCola, that kind of thing is typically in the value space, right? Like, it's unlikely that Coca-Cola is going to invent a new kind of drink that just revolutionizes the way people live in the way that tech stocks hope to do. But it's profitable, they pay dividends, they're pretty steady. And in a market like this, Coca-Cola, we can look at the chart for Coca-Cola here. Yeah, Coca-Cola year to date is doing pretty well, whereas we can just, I think, throw Tesla right on here. Something like Tesla is, yeah, doing significantly less well. Up 7.8% versus down 19%. Right, Coca-Cola is not going to gain 500% in a year like Tesla has the ability to do, but it's also unlikely to lose 20% in 4 months. When people say hold a stock for the long run, how long potentially are we talking? Until retirement? Potentially, yeah. It really depends. Some people sell things because they think they've gotten, the company is, you may sell when management changes or something like that. But yeah, typically long run, people are talking years or decades or something like that, as opposed to making a relatively quick trade. Is 2022 going to be a bear market or sideways market based on interest rates, inflation, possible recession, etc.? There's a lot of what I think people would call headwinds facing stocks right now in terms of rising rates, inflation, some number of uncertain world geopolitical events. So yeah, it's not impossible that things won't go super high here. We're already pretty well off the highs for the year. I mean, the highs for the year were set back in January, like the 4th, I guess, the 2nd or the 3rd, maybe, the day the market opened for the year. It's really hard to predict the future. If I had told you everything that was going to happen in 2020 in terms of pandemic and everything like that, you probably wouldn't have had the market up for the year at that point either. So, things happen, and it's really hard to predict what happens. I don't know. Which is why I think all the things I've said earlier about like rebalancing and trying to have a diversified portfolio and things like that are really the best practice in terms of trying to make any money investing. All your stocks won't go up, but if you do it right, some of them will. And that's really kind of how the game is played. Prospects for major biovaccine makers like Pfizer and Moderna. I would count those. Okay, and then there's another version of the question that includes Johnson & Johnson. I would count those as very different companies in the sense that Pfizer has a pretty big business that's not making COVID vaccines, and Moderna makes a COVID vaccine and is working on a bunch of other stuff, and that's about it. So I think those are very different. Moderna seems more speculative to me than either Pfizer or Johnson & Johnson. But like anything in the healthcare space, you're really one good or bad headline about a drug trial away from, a big rally or potentially a big drop. I have some exposure to those stocks through ETFs that I hold. And that's how I prefer to do it, because I don't feel like I have any advantage when it comes to knowing if one drug or another will actually work better. So it just doesn't make a ton of sense to me to try to pick the winners there. So is the scoring system back tested? The scoring system is based on, strategies that have worked for, decades, basic fundamental and technical analysis. We have tweaked it over time to make it better. We have looked at the historical results and plan to continue doing that to try to tweak it and make it better. We haven't done a lot of extensive back testing, since we launched it, but we are constantly looking at how it works and planning to make tweaks and adjustments as necessary to try to improvement. Cannabis stocks. Cannabis is interesting. It certainly seems like it could be a big growth industry. It also remains true that cannabis is illegal at the federal level in the United States, which seems like where that the most of that growth would be. That means it's very hard to get funding for medical research on cannabis from a lot of anybody taking federal money. It can be hard for cannabis companies to get bank accounts, things like that. It's still very speculative. And in terms of any individual stock, I have a hard time, like I said earlier about farming, right? Like farming is difficult. It really comes down to kind of owning land and what you do with it. Obviously, cannabis tends to be grown in greenhouses and things like that. But functionally, you're growing a plant and selling it into a marketplace. And so it tends to be a pretty low margin business by and large, because at a certain point, most of the product ends up being the same. So it's difficult to say exactly what the outlook is for any individual stock, especially given the remaining federal prohibition. Like were that to be lifted, I think certainly the picture would change and you'd see a big rally in a lot of those stocks, but I don't have a good sense of when that would happen. All right, so why is KULR still considered a strong buy when it's been going down for the last month? All right, so this strong buy here is, as the note says, the average recommendation of Wall Street analysts. So this means that the people who work in investment banks, broker dealers, whatever else, think it's a strong buy. Typically, they think it's a strong buy because they like the prospects of the company. Yeah, I mean, this seems like the sort of thing that would be in the, to go back to that sort of growth versus value thing, right? One of the tricky things about managing electronics is managing heat. So if you can do thermal management, in a new or interesting way, that ends up being pretty useful. I know what some number of these words mean, but I couldn't begin to speculate on whether this particular company's products are any better than their competitors. The Wall Street analysts tend to think they are. But yeah, I mean, like we said, right, like value stocks have been getting beaten up over the last, growth stocks have been getting beaten up over the last several months. This is functionally an unprofitable technology company. That kind of thing is hard to value. Okay, so follow-up is, who are the analysts that are analyzing and making the predictions of the next 12 months movements of the stocks? How broad are their backgrounds? How many analysts would be included in shaping the charts in IO? So both this rating and these charts come from Wall Street. So how many depends on typically the size of the company, right? Apple has a ton of analysts that follow it. Basically, everybody who's doing analysis has somebody who's following Apple and the other big name tech things. For something like this, where it's a relatively small cap company, it's not nearly so many. And typically what those analysts do is their job is to try to figure out how to value the company. And they do that typically by trying to figure out what the growth prospects are, what the outlook for profitability looks like. Usually there's some sort of discounted cash flow model that gets made, in terms of, this is when we think this company, functionally anybody who owns a business, which is what owning stocks is owning a part of the business. And you do it because you'd like to get some money out of it, right? And that means earnings. So, you try to figure out when the company might be profitable, when you might have a chance to get some of those earnings, and then work backward to a fair stock price or a fair stock price over the next 12 months from there. How broad the backgrounds are, they typically are, people with a background in finance. But yeah, I mean, people hire analysts in different ways. A lot of them have a CFA charter or something like that. Some of them have MBAs. but they typically tend to be financy people. But they also specialize, right? Like somebody is unlikely to be both a bank analyst and a biotech analyst because those are very different companies. So there is a little bit of specialization that goes on there in terms of what you're analyzing, but functionally you're doing financial analysis. So those people tend to have financial backgrounds. All right, got another stock somebody wants to look at here. Yeah, this is another biotech stock that has had a couple of peaks and then fallen off. Like I said earlier, right? Like all of these companies are doing very expensive science experiments and hoping to find a product they can sell. Oxygen doesn't make a profit. Don't know exactly what their pipeline looks like. Clinical stage biopharmaceutical typically means they don't really have anything in production or anything that's big in production. So yeah, right. Like these things end up being very speculative and difficult to value because of that, right? Like they could hit it big. It looks like there's been some optimism recently, but even more recently, there has been, a lot more selling. Stronger fundamentals or technicals for biotechs. As I said earlier, I don't really trade in biotechs because they trade based on that sort of news that I find to be difficult to predict, right? This company has no real fundamentals, right? Like it loses money, and it loses money almost every quarter. What's the fundamental analysis of that, right? Like in order to evaluate this company, you have to know what kind of drugs it's trying to produce and try to put some value on both the likelihood of them being approved and then what the potential profitability of those will be down the road. And I don't have any good way to do that. As you can see here, this stock has been, at 1560 and 222 in the last 6 months, which suggests that an awful lot of people don't really know how to value it. Technical analysis can be a little bit better, but the news will trump technical analysis pretty much any day. Let's see here. Boeing. Boeing is interesting because it's a big business and they have a lot going on. You would kind of think that the airline business would do okay with people going back to flying, but in terms of big ticket purchases that might get hurt by higher interest rates, Boeing absolutely falls in there. High oil prices also tend to depress flying a little bit. So even though people are coming back to flying on a post-COVID basis, there may be a little bit less flying than there would be otherwise because of just high costs for flights. Boeing's also, of course, in the defense space. So, things like war in Ukraine are relatively, I don't know about Boeing specifically, but those sorts of things tend to be good for those stocks. Boeing's had a lot of problems with plane crashes here recently, though. So it's, the stock has been beaten up because of that, but I couldn't, analysts seem to like it and think it should be higher. That is certainly something to consider. I'd like to see them return to profitability, but that seems like a really hard one to call just because of that, that uncertainty about whether or not aircraft orders will pick up. All right, it's after 5. I'm going to go ahead and sign off here. This session has been recorded. We will post that recording on the website tomorrow. You should get an email about it. It'll also show up somewhere in this featured news section tomorrow, and then you can find all of the old workshops here under the personal finance and investing section of the website. So, yeah, thank you for coming. Thank you for subscribing to Investors Observer. You don't have to wait 3 weeks to get questions answered. You can hit this help button here in the bottom corner of the website. If you would like to see me put together some slides to talk about something in a little bit more depth, by all means, you can send it in the same way. Just say, hey, talk about this at the webinar. Thank you. Bye.